Well, hello everybody and welcome back to another Westpac post-RBA discussion. And I'm joined today by Westpac's new Chief Economist, Luci Ellis, who's joined from the RBA, as well as Damian McColough, Head of Rate Strategy. I'm Martin Whetton, Head of Financial Market Strategy at Westpac. Luci, today, as expected, the RBA delivered the rate hike, but that's come after a period where they've been on hold since June of this year. What did you see, having predicted this, that changed the reason for them to go today? And what did you see in the statement today that surprised you?
Martin, we were expecting that the Reserve Bank was going to raise rates today. It was a pretty finely balanced decision, but in the end, the increased outlook for inflation was just something they had to respond to. Inflation's too high, the Reserve Bank is trying to get it down, and they're finding that to be a tougher task than they originally forecast. They are still forecasting that inflation will get back into the band in 2025, but they're finding that inflation is proving more persistent than they'd previously expected. But perhaps the most surprising thing that I saw in the release was that they've also revised down their unemployment forecast. And that's telling us that they're realising that there's a little bit more resilience in the real side of the economy, even though the households are being squeezed by cost of living pressures, higher rates, higher tax take. And some of that's been a bit unexpected, but it is the sort of thing that we've been seeing in other countries as well. So they've responded to that with their outlook, and we'll know more when they release their statement on monetary policy on Friday.
Yeah, you're right about that resilience. It has been a bit of a story around the world, and it's meant, I guess, in a lot of ways that market pricing or expectations for central banks has been both high and elongated for a period of time. I'm wondering, even with that huge amount of migration or net migration we're seeing into Australia, how the RBA can actually keep or lower perhaps their forecast on the unemployment rate even in the face of that. And what does that tell you really about how strong the economy really is?
I wouldn't describe the economy as strong, but I would describe it as resilient. Individual households are getting squeezed. Part of the reason why there's been so much increase in labour supply is that plenty of people are finding that they need additional sources of income in order to cover the increased cost of living, including higher mortgage payments, but also just higher prices more generally. And it is that higher inflation that the Reserve Bank's responding to. But that's for an individual household. That's multiplied by a much larger population than a lot of observers were expecting. Forecasts of population growth are being revised up. The official expectations of the number of entrants to the country this year have been revised up. And so that's adding to demand, but also to the supply of labour. Most of those new entrants to Australia are young adults, and they typically are participating in work.
So if we take out the inflation number that we saw recently, which was obviously a little bit higher than expected and took the RBA into the move that we saw today, and we look at the labour market and I guess the net migration story, do the forward indicators give us some idea or thought that we're going to see some further weakening in labour market pressures?
Well, we do expect the labour market to ease from here. It has already turned, and the Reserve Bank expects that as well. It's just that their expectations for unemployment have been revised down a little bit, from 4.5% in 2025 to 4.25%. That's not a huge revision, but the direction of travel is quite revealing. I think the main reason that they have raised rates, though, is just the fact that inflation has proved more persistent than they expected, even though we don't expect that the December quarter CPI number will be as strong as September quarter. It's just the detail of what we're seeing in the inflation numbers is showing us that there's more persistence, it's more widespread, particularly services prices, but also elements of goods prices and housing related inflation. And the Reserve Bank's just had to act on that because otherwise inflation simply will not come down back into target. And if that doesn't happen, there's a risk that inflation expectations will become entrenched at a high level, and that makes it much harder to get inflation back down again.
That's right. In terms of the mortgage cliff, that's been a big story for some period of time. We still feel as though we've got quite a bit more in the course of this year for people to roll off their fixed rates into floating. Obviously, the RBA takes that sort of detail into mind with their policy. How much do you think, as we hit this end of the calendar year, will they think about that for early next year and the impact of policy as a bit of a drag?
I think another way to think of the mortgage cliff is the mortgage extra time to plan. There are a lot of people who fixed rates on their mortgages during the COVID period, and if they hadn't done that, they would already be paying higher rates. Instead, they've been enjoying a lower repayment for a period. They've been able to plan for that, and what we're hearing from our own bank's results is that quite a lot of the people who are rolling off fixed rate mortgages are bringing additional savings back into their main bank, and they're using that to rework their mortgage, and they actually had quite a lot of buffer of savings, and they're ready for that higher repayment because they could see it coming. Now, of course, there are going to be some people for whom that's much more of a struggle, and we're also hearing about households who are really having to make quite difficult decisions about their spending patterns, quite difficult decisions about what they give up, or to increase their participation in the labour market in order to gain more income. So it has been a struggle for a lot of people, but what we hear from our own bank colleagues is that actually, for most people, the mortgage cliff has been a mortgage additional time to plan.
Thanks, Lucy. And now, Damian, turning to you in terms of the market pricing, we had obviously this one almost fully priced, and there'd been a little bit more priced in for later this year, early next year. How's the market gone as a result of today's decision?
Yeah, well, certainly they removed any chance of a December follow-up rate hike, and I think that's the appropriate thing. They've taken about another half a rate hike out of the forward cash profile by middle of next year, but maintaining that kind of upward sloping forward cash profile, understanding that in the same way that the RBA's had to respond to the data this time, that could happen again on the next, I guess, quarterly cycle would be the way that the market was most thinking about at the moment, making February, an important meeting.
Yeah, so they don't want to give away the idea that that's it from the RBA and we're going to price in the cuts from here.
No, but it was interesting to see the market rally, the bond market rallied on the outcome, and that was all about that, just that change of wording in the final paragraph, which was perceived to be more dovish than what the market expectation was. So whether or not that's just a short covering piece and then we move on, I think that's more likely to be the case. That's yet to be seen. But things like yield curves, flattening down, supported by global investors who are looking at the Aussie-US 10-year spread, which had widened because we priced in more rate hikes, are things that I think are in focus right now, and this gives the market freedom to establish risk in those positions.
Currency was down a little bit too on the spot and the crosses, but Aussies enjoyed a reasonably solid couple of weeks. So the China story seems to have abated somewhat. Still think that we sell the Aussie on any topside moves?
The interesting thing there is whether or not the US dollar backdrop is going to remain as supportive for selling strength in the Aussie as what it has been previously. And it's up to debate whether or not that US backdrop is as strong as what it was. But I think that the real message from me as a rate strategist around the currency is that I think that we've seen global investors being more comfortable in the last month with where the Aussie dollar's got to and where its upside potential has been or is likely to be. And the RBA delivering a rate hike today supports that.
Great, thanks both. So as expected, the RBA delivered the rate hike that the market had priced in. There was a change in the language towards the end where they seemed to move towards at least taking away the December hike as a back-to-back move, but keeping the optionality there for any moves next year if the data still surprises to the upside. As Lucy mentioned, there is a change in the unemployment forecast, which does go a little bit lower. So really what we see on Friday's statement of monetary policy is going to be pretty key for the forecasts and how the markets trade as a result.